The electric vehicle industry has been under intense pressure throughout the course of 2021. An industry-wide lowball estimate into the quantity of vehicles that would be delivered catalyzed this crisis into motion. To everyone's surprise, 2020 was actually, all things considered, a healthy year for worldwide vehicle sales, and specifically electric vehicle sales. After the major plunge in Q1 of 2020, the industry rebounded, which was quite an oxymoron and puzzling for a lot of investment firms. With strain on the economy, consumers working from home, not commuting to workplaces, and with essentially nowhere to go, it was a bit of a shock, to say the least, to see consumers actually purchasing vehicles at a faster rate than expected. This frenzy drove up market capitalizations of EV companies like we had never seen before, compounded by a clean energy-focused government and major subsidy programs. But could this boom all be coming to an end? Are we in a bubble? In today's episode, we're going to be diving deep into the challenges the electric vehicle industry is facing moving throughout 2021. We'll be touching on the chip crisis, what this means, and when this may be resolved, and ultimately what investors should be expecting. I'll be framing the situation around EVs and NIO specifically, but this is an industry-wide and really tech sector-wide crisis. Now, this video is not to fearmonger. I really just want to paint both sides of the story. In this video, I'll be highlighting some concerns I have. However, in my next video, I'll be highlighting the bull case. Welcome to the show. My name is Nick. Before we get to it today, Webull is giving out 2 free stocks worth up to $1,850 for free. You could trade before and after hours markets. They are 0% commission. It really is a win-win. All you have to do is use the link in my description. Anyways, ladies and gents, let's jump right into it. The EV industry is under strain directly caused from the global semiconductor shortage. Semiconductors, also known as microchips, or typically just called chips, are crucial components to tech products. As their name implies, they are materials which possess conductivity between conductors and non-conductors used in electrical circuits. Semi for not too conductive, yet not too insulative, just right. Now, these increasingly thin chips, just a few nanometers in diameter, are in major demand from the electric vehicle industry. With the advancements of autonomous driving and increased technical components to vehicles, we're actually witnessing an increased quantity of chips per vehicle. Now, this increased demand per vehicle, paired with the increase in demand for electric vehicles, is placing a huge strain on production of chips. Now, when you add in the tech products boom that is still continuing as workplaces become decentralized, we run into a very precarious situation. The chip shortage is becoming a crisis, and supply is dwindling as demand is exponentially increasing. This has led to major vehicle companies vying over the sought-after product, fighting against each other to source. However, none of these companies have a safe supply. We have seen the top names in the vehicle industry halt productions of vehicles, at least to some capacity, sacrificing revenue and delivery numbers. VW, Ford, GM, Tesla, NIO, virtually not one company has managed to leave this crisis unscathed. Now, the majority of semiconductors are fabricated in the US. However, their advancements into this technology itself is slowing and lagging behind competing countries. Intel, the largest US chip producer, led the US to control around 48% of the market share throughout 2020. This poses quite good for US EV investors. Now, if you have watched my show before, you will know I am extremely bullish on the long-term prospects of NIO. Now, being a Chinese company in this atmosphere inherently poses issues for the company in terms of semiconductor supply. China is a net importer of chips, having imported $350 billion worth in 2020, an increase of 14.6% from just the previous year. Their technology, just like the US, is starting to lag behind competitors such as Taiwan, currently a world leader in chip tech and owning 51.5% of the foundry market. The simple fact that Taiwan is a world leader in this production has led many policy analysts to believe that this may be the one aspect preventing a China-Taiwan military conflict. So huge geopolitical impacts here. TSMC, the world's largest chip producer, believes that it will be able to catch up to the automotive demand by June this year, something that many analysts seem to believe almost impossible. Now, the US has also imposed tighter exporting controls of chips to competing countries like China, posing even more problems for EV companies like NIO in securing supply throughout 2021. Chinese companies like NIO have gone on record for investors to manage their expectations. We recently saw a 5-day halt in production due to the shortage, and the company has lowered their Q2 estimates and beyond. Li Bin, NIO's CEO and founder, has stated that the problem is likely to get worse before it gets better. China is investing massive sums of capital into becoming chip independent. However, they're unlikely to meet their lofty goals and will likely have to rely on other countries for the next few years at a minimum. Now, this concern, amongst other factors, is sparking fear in investors of EV and tech companies, driving down share valuations as investors sell off speculative plays. As many EV companies are growth companies, a stagnating delivery output due to supply strain on semiconductors could drive out institutional capital and in turn drive out investor interest. Growth companies rely on increasing revenue every single quarter and essentially need to stay relevant, especially in the ultra-competitive EV space. EV companies, and NIO specifically, has guided for very modest revenue gains moving throughout Q2 of only around just north of 1.2 billion USD, a very marginal increase of around only 2 to 6% from Q1 2021. Going even further, this increase is only largely because February in Q1 is such a historically terrible month for auto deliveries in China due to the lengthy lunar holiday and the low day count. All things considered, they would likely see a dip in revenue if this had not been the case. And that brings me to the real issue of Q3, when we are likely to see a decrease or a complete stagnation in revenue and deliveries. It is not out of the realm of possibilities to see yet another production halt for NIO and other EV companies, which could send shockwaves through their valuations. Keep in mind that NIO is currently the 10th most valuable vehicle company on the planet, with a market cap of around 54 billion USD. This signifies that there is already a ton of speculation and future projections already priced into their shares. If we see increased speed bumps along the way, a lot of the speculation could quickly vanish. Now, when is the chip supply expected to catch up to this increasing demand? Well, the exact timeline varies widely, ranging from a few months to multiple years. Glenn O'Donnell, VP Research Director at Forrester, has a consensus the shortage should last until about 2023. We need to keep in mind that although chip companies are drastically increasing their production, that demand is already outpacing this and is only expected to increase. He states that, quote, "Couple that with the unstoppable desire to instrument everything, along with the continued growth in cloud computing and cryptocurrency mining, and we see nothing but boom times ahead for chip demand," unquote. This is a problem that is going to perpetuate, and I am concerned of sourcing for Chinese companies like NIO. Now, there are reports that NIO will be able to secure a robust supply and catch demand by Q3 this year. And it does help that they are a luxury vehicle company, so it can achieve high margins on few vehicles sold. It's not purely a numbers game for them, but they will be under strain for quite some time. I do think this is the cause of much of their yo-yo-like volatility in the mid-30s currently. I do think had this chip supply not shuttered the entire industry, that they would still be skyrocketing ahead. They are currently constructing a facility with production capacity of around 1 million per annum, set to begin production next year. However, without their crucial chips, this is all completely fruitless. Now, I am currently holding at these valuations, however, will be buying if we see shares drop below 30 into the high 20s. I think these will be fire sales in the coming years, as I do plan on holding NIO at this point in time for years to come. However, there lies no clear escape from this continuing crisis, and I am not comfortable with how out of NIO's hands this problem currently is. They are essentially at the mercy of semiconductors and their supply. For now, I am bullish that they are using this time to expand into other regions and actively promote other aspects of their business, not relying on chips, such as NIO Life and partnering with huge brands. We also see them aggressively moving into the energy industry through NIO Power, all factors I will be touching on in my next video, NIO's bull case. Don't forget about the Webull promo, 2 free stocks worth up to $18.50. All you have to do is use the link in my description. Who doesn't like free stocks? You could trade before and after hours markets. Webull is 0% commissions. It really is a win-win. Anyways, everyone, see you all in the next video. Hit that subscribe button, smash the like, take care, happy trading, cheers.